we're going to take a quick deep dive on a super simple level of what happened with Silicon Valley Bank. Since they've been in the headlines, we've seen the 2-year US Treasury drop from roughly 5% to 4%. This means that bond investors think that there's going to be a rate cut before the end of this year. Let's say rates are currently 4.5%, and all of a sudden the 2-year US Treasury drops to 4%. What that means is that investors think in year 1 the return might be 4.5%, but in year 2 it might only be 3.5%. They get there because rates would have to drop like they did from 5% to 4% on the 2-year US Treasury. So they're pricing in rate cuts between now and when that 2-year Treasury is going to expire or run off. The Fed meeting is next week as well. We think that the Fed is going to still hike rates 25 basis points. Why is that? Well, inflation is still running hot and unemployment is at 3.6%. The Fed is okay with unemployment getting up to 5%. Jerome Powell said it at the last meeting and over the last couple months that he wants to make housing more affordable. How can he do that? By raising interest rates. Prices you would think would come down if interest rates continue to increase and people's monthly payments become more expensive. This will allow more people to buy houses. Recently, we saw First Republic Bank's shares drop from over $100 per share to $30 per share. We don't see any insiders, CEOs, or CFOs buying their own stock. It's interesting to know how will that play out. Actually, over the past couple of days, we saw big banks inject liquidity into First Republic Bank to try and save it. So let's dive into what happened with Silicon Valley Bank on a super simple level. And before we do that, let's take a look at the role of a bank. Banks make money by taking your deposits and then lending it out at a higher interest rate. So say you give $100 to the bank and they go and lend it out to somebody else, that full $100. The money in the bank that you have is not actually your money. It's now a debt to another person who the bank lent the money out to. You place your money into a savings account with the bank. The bank then lends that money that you put into your savings account to other businesses and people. Those people and businesses pay the bank back with interest. You earn interest from having money in your savings account, and the bank earns the spread between the money they pay you in the savings account and what they receive from other businesses and people. In normal times, let's use $100. If you give the bank $100 and put it into a savings account, they're going to pay you 1% or $1. They're going to take that $100 and lend it out to somebody else at 4% and collect $4. They pay you $1. They've collected $4. They earn the spread of $3. Over 30 years, you would have gotten $1 each year. The bank collects $4. They make the spread of $3 every year. Super simple. If we were to increase the numbers, and let's say you deposit $1,000, you get paid $10 every year. The bank takes your $1,000, they lend it to somebody else. They collect $40 a year, which is 4% interest, and they collect the spread of 3%, the 1% they're giving you, the 4% they're collecting from somebody else, and that's $30 that they make every year. Let's make this super simple with Silicon Valley Bank. Let's say that they have $100 billion of deposits that they will now lend out. So instead of lending it, they go and buy mortgage-backed securities. They buy $100 billion worth of mortgage-backed securities, yielding 1.5% and with a 10-year period or duration. Silicon Valley Bank predicted that interest rates were going to stay at 0 for a long time. So they're paying their depositors, the people who have $100 billion in the bank, 0.1% per year on that $100 billion. They've bought $100 billion worth of mortgages, earning them 1.5%. The spread is what they collect. So they're earning 1.5%. They're giving their depositors 0.1%. They're earning 1.4% spread, or $1.4 billion per year on all of the deposits. It sounds great until the Fed comes in and says they're going to raise interest rates. So the Fed has quickly raised short-term interest rates from nearly 0% all the way up to 4%. The 10-year risk-free rate went from being 1 to 1.5% to now over 4%. That's a much higher return than the 1.5% that they've been earning from their mortgage-backed securities. So how does Silicon Valley Bank get her? Well, their clients who have deposits in the bank only earning 0.1% now realize they could pull that money out and go invest it elsewhere and earn a higher return. So you're having companies and high net worth clients who have, let's say, $20 million in the bank say, well, I'm only earning 0.1% with Silicon Valley Bank. I'm going to pull that money out and I'm going to go invest it somewhere else where I could earn 3% on my money. mean, on $20 million, instead of earning 0.1% per year, which would equal only $20,000, they're going to pull that money out and go invest it elsewhere. Let's say they could get 3% on $20 million. That's going from $20,000 per year they earn all the way up to $600,000. So their clients are transferring the money and pulling it out of Silicon Valley Bank and investing it elsewhere with higher returns. Now, also, those $100 billion of mortgages that they bought at 1.5% are now worth a lot less than $100 billion because interest rates have gone up. That portfolio might only be worth $80 billion now. So here's how they get hurt. The first year, they collect that spread of 1.4% and make $1.4 billion. We got there because on the $100 billion that they were earning 1.5% on, they had to pay 0.1% to their depositors, and they were collecting the 1.4% spread of $1.4 billion. So rates have now gone up, and let's say they're 4%. Silicon Valley Bank, you have rates at 4%, you still have a portfolio of mortgages only yielding you 1.5%. As rates have gone up, they have not sold that portfolio or hedged that risk. So they're still collecting 1.5% on $100 billion or $1.5 billion. But rates are 4%. People want to earn 3% on their deposits. So if they have to pay their depositors 3% now, but they're only collecting 1.5% from their mortgage portfolio, they're going to lose $1.5 billion. If they pay out $3 billion, they're only earning $1.5 billion still. They're going to lose $1.5 billion from what they make, what they have to pay out, and what their customers want. Now, if they are going to pay out the customers 3% and lose $1.5 billion each year, which makes sense, why would they want to do that? Their customers are going to pull money out of the bank and go move it elsewhere. Well, when a customer wants to pull money out of the bank, they have to actually give them cash. But what they did with the $100 billion a year ago is they bought a bunch of mortgage-backed securities. They have $100 billion worth of mortgage-backed securities. Well, it's not worth $100 billion now because interest rates have gone up. It's only worth $80 billion. Now, if all of their clients pull out the money that they have in the bank, which is $100 billion, and they took the $100 billion and invested it in mortgage-backed securities, and the value of those mortgage-backed securities are no longer worth 100, it's only worth 80. If they were to go sell the $80 billion portfolio and all of their clients were to then come and ask them to pull out all of their money, they would be short $20 billion. The portfolio of mortgages went from $100 billion to $80 billion. The client or their depositors still have $100 billion in the bank. They pull everything out. There's not enough to pay everybody. They're now insolvent. So even if SVB were to sell the full portfolio of mortgage-backed securities, they're not going to have enough money once it's sold to pay back all their depositors. And that's how we got to where we are today, where the Fed had to step in, guarantee deposits, and somebody might be actually buying Silicon Valley Bank. I hope that was a somewhat simple explanation of what happened. In general, they bought a bunch of long-duration assets at 1.5%. Interest rates moved up to 4%. Their depositors wanted to earn 3%. If they were to pay 3% every year on $100 billion, they would lose $1.5 billion, the spread of what they're earning versus what they would have to pay. They aren't doing that. So clients wanted to pull money out of the bank. When they go to pull money out, SVB had to sell mortgage-backed securities that they bought at a price well below what they paid for it. So maybe they paid $100 or par for those mortgage-backed securities. Now they're selling them at 80 cents on the dollar. So they're losing 20 cents. But on a large enough scale of $100 billion, they're losing $20 billion. And that is how they went under. So if you enjoyed this video, please like and subscribe to follow along for more content on mortgage lending, real estate investing, and personal finance.